go?
I'm ready whenever you are.
All right. Finance Committee will come to order. Good morning, everybody. Thank you for being here. We're going to dive right in. Any citizens wishing to address the committee this morning? We do not have any. Item 3, minutes from the October 25th meeting. I'll entertain a motion for approval. Motion by Mr. Bose, second by Mr. Nguyen. All in favor, please say aye. Aye. Opposed, motion passes. Item 4, CFO report. Ms. Clark. Good morning, Sharon.
Good morning. How is everyone? All right. So we have started, actually, let's see, that's for Southwest. Do I need to click through that, or let me just go ahead and click through, see if my presentation, I think we may have gone a little out of order, so here we are. So we are finally to a new fiscal year. October, once we get back to the financial statements, you'll see that year to date is the same as the month. So we're glad to be able to start in our new budget. So we have a couple of really high volume months, and there's some statistics that I'm going to spend some time with you on today. We have our admissions were very high, about 2.5% above budget this month, and you can see based on the trend line, although it's fairly in line with July and August, it's still a pretty high month. Our case mix index was slightly ahead of budget as well, and our length of stay was about 5.06 days for this month. You'll see in the key outpatient statistics, although emergency department shows to be slightly under budget, it is very high still. You can tell by this blue bar, we're still on trend with some of the prior months. And then I wanted to point out primary care and specialty clinic visits. We have had some high volumes in specialty, and that is mainly due to the way that we are focusing on scheduling, trying to increase that patient throughput on a monthly basis. And so I know that that was an area of interest for a lot of our board members. So we're starting to see an uptick there. From some of the other areas, I did want to point out that our invasive labs is extremely high. Once again this month, it's the highest month since we've implemented the service and brought it on board. And then also particularly interesting is our inpatient and outpatient surgeries for the month. You can see that inpatient surgeries, we actually capped right at 600 surgeries this month. That is the highest inpatient count that we've had over the last 24 months. Our outpatient surgeries are also trending upward, although they're showing slightly under budget at about 3%. If you look at our trend line, it's significantly higher than where we were ending up last year. So both our inpatient and outpatient surgeries are going very strong. There is not a one area, you know, I visited with Wanda a little bit about what was going on in some of our inpatient areas, and it just seems to be everybody is kind of getting up to speed. You'll see that, you know, if you remember, our ED volume was very strong, and I would imagine that some of those inpatient surgeries are coming from that volume as well, because it was a lot of general surgery. Our psych area, there have been some operational changes that have been made over the last few months that have started to impact some of these statistics as well. For patient days, you can see that that was above budget, about 4%. It was also one of the higher months on the graph. We have begun trying to discharge our patients more quickly, so that will increase our throughput in those psych beds as well. They've created a discharge lounge, so as patients are waiting to get rides or coordination with case management, they can actually be moved from that inpatient bed into more of a lounge setting where they're comfortable, but it also allows us to clean that bed and get a new patient in. You can also see that our psych clinic visits were very high. We had a high month last August, so it's kind of right on trend, but they were about 13% ahead of budget. You can see that going up. And again, conversations with Zelia, she feels like this has a lot to do with the fact that we are making appointments upon discharge. There's an increased focus on that, which will hopefully prevent other PEC visits and admissions. On the ED, we did have an uptick in ED. Most of those are just patients coming in. It's not much higher than the last quarter of last year, but it is ahead of budget. So for our financial metrics, our days cash on hand that's available for operations once we set aside the JPS Future Fund is at 141. We did get a large dish payment this month, but this historically is our low cash time of the year. We will get a lot of money coming in December and January from the ad valorem tax, and you can see there's kind of a big increase here, and then we just slowly draw down through the rest of the year. Our days cash on hand, including all cash, is about 189. Our FTEs per APD for this fiscal year, once again, are favorable. Our end of year goal is about 5.72 FTEs per adjusted patient day, and we came in at about 5.54 this month. Connection enrollment has leveled off. We had a small increase there of about 162 patients. So for the month, again, this is year-to-date as well, due to the first month of our fiscal year. We did have some really strong inpatient volumes. As we look at the bottom line, we were $1.1 million ahead of our $791,000 budget. We did have strong revenues. You could see both the inpatient and outpatient area, especially in surgery. And we did have also a favorable mix towards the inpatient areas. So with inpatients, our payer contracts will actually pay us more as a percentage charge than our outpatient areas do. Salaries and benefits, we were right on target for dollars of salaries this month. And benefits were slightly over. We had a bit higher on the employee health claims, but that was offset with some savings and benefits. Supplies, you'll notice, is about $590,000 ahead of budget. That's due to, once again, some of the inpatient volumes and especially the surgical volumes that we've seen. Also, something that happened in October was our annual receipt of our vaccine inventory. So that was received and distributed to some of the primary clinics as well. We are off to a good start. That is one of my old mentors used to say, you know, more money is better than less money. So it's always good to start out ahead of budget.
It's a wise saying, yes.
Simplifies a lot. So for a claim, again, new budget year, they actually are about 3% in encounters ahead of where they had planned to be. And the net operating expenses per encounter is favorable to budget. So just the average cost it took to produce that revenue. Our new graph, as requested by our Finance Committee Chair, you missed it last month, Steve. But again, there's a lot of information on here. This used to be on the next page and was a very small graph, but we've also expanded it not only just for the specialty, but also how many positions might be open in each specialty, as well as contract versus employed. So out of the 446 FTEs that are here, 393 are employed. We have 8 contracted and 45 open.
Yeah, this really does have a lot of information and good context to it, so I like this.
It does. Good suggestion.
Thank you.
So for a claim, they had a favorable month as well. Looking at our net income, a $1.5 million loss compared to $2.2 million. So they were about $600,000 ahead of their budget. Again, they had a nice, strong revenue month with encounters being 3% over. And then the underages are also related mainly to the salaries for those 45 open positions. Are there any questions on a claim? You know, when you look at us from a consolidated, we're at about a $1.4 million combined compared to a budgeted loss of $540,000. It's not surprising that we have outperformed our budget. We work really hard in September to get as many expenses appropriately in fiscal year 18 as we can. So this is often the case that October will have lower expenses, but we had some great volumes in both of our entities. Any questions?
Any questions for Sharon on any of the financials? Okay.
All right.
And Sharon, I apologize. I get my A's and B's mixed up sometimes. You were actually B, and
Let
so
me
Greg
flip
was
back.
A.
Y'all don't look. I don't want to steal Greg's thunder. But yeah. So
I'm a public school kid, so what do you expect?
No, I think you're a unique kid, though.
Hey. Greg, would you like to come up and join us up here?
yes. So Greg Warner, I have had the pleasure of working with him since I arrived here. Once a year, we invite First Southwest Asset Management to come and talk to you about how our funds are invested. And if you have any questions, please let him know. You're welcome. So you know how to work it.
I'll figure it out here.
Do you want to learn this at all?
I watched you.
Oh, okay.
I'm ready to go.
All right, welcome, Greg.
All right, perfect. Well, thank you all. I appreciate the opportunity to be here today. As I go through this, please feel free to chime in or interrupt along the way with questions. If I don't hear you asking questions, I'll just keep moving forward and plow right through it. But please don't be afraid to jump in if you have questions as we go through this.
This is not a bashful bunch. So
Good,
yeah.
good. So this is a portfolio summary by fund and sort of shows the breakdown of each of the major fund categories that we work with for you. The portfolio in total had a market value as of September 30, 2018 of about $551 million. That's actually about $25 million less than the same period a year ago. That decline was really concentrated in the operating fund, which fell from $387 million to about $344 million. Last year, the operating fund made up about 67% of the portfolio. This year, it's only a little over 62%. The future fund, on the other hand, had a pretty substantial increase. It grew from about 20% of the portfolio to 23% of the portfolio. Now, one thing that's important to note is this is not investment results. This is not a result of the value of the portfolio falling. This is just the ebbs and flows of cash flows and the timing of payments in the various funds, in particular that operating fund, which has your main inflow in and outflows from month to month. The other smaller funds stayed fairly constant in terms of their balances. The other thing that's really important here down at the bottom is we detail the earned income by fund, and I heard earlier that more money is better than less money. So 58% increase in net income versus 2017. So the portfolios in total earned about $10.8 million fiscal year 18 compared to about $6.8 million in the same period of 2017. Now, as much as I'd like to take all the credit for that, the primary cause of that is just the general increase in the interest rate environment. The Federal Reserve, of course, has been on a path of raising the Fed funds target, and interest rates across the yield curve have sort of been following along with that. In the course of the last year, ended September 30 of 18, we've seen roughly 100 basis points worth of increases, a full 1 percentage point increase from the Federal Reserve, and that's filtered through to most market rates, and certainly is having an impact on the portfolio itself. On page 3, we'll take a look at some of the portfolio characteristics. The gray box here, the bottom of this gray box, shows the weighted average YTM, stands for yield to maturity. That's the key measure that we're looking at here. At the end of this year, yield to maturity in the portfolio is 1.97%, so we're just about to climb over 2%. In fact, by the time we finish October reporting, I believe we'll be over 2%. And that compares to about 1.22 the same period a year ago. So we've seen roughly a 75 basis point increase in the portfolio yield. Now, I just told you that the Fed had increased overnight rates by about 100 basis points. The last 25 of those came at the very end of September. So the portfolio hasn't quite reacted to that final increase yet. The portfolio yields will lag a little bit on the way up. I'll show you that here on a different chart here in just a moment. But the portfolio yield is continuing to rise, and we do expect that will continue for the next several months. Looking at the pie chart on the top right of this page, we note that the portfolio has about 19% in U.S. government agencies. That consists of 8% in what we call agency bullets. These are simply non-callable securities that will be held until maturity. We also have about 11% in callable securities. These, in theory, could be called away from you prior to maturity, but in an environment where interest rates are continuing to rise, that's very unlikely. So essentially, a little shy of 20% of the portfolio in U.S. government agencies. Down there at the bottom there, we also have treasuries, which make up about 18% of the portfolio. So all told, about 37% of the portfolio is invested in U.S. government or U.S. government agencies. Local government investment pools, shown here as LGIP, makes up another 25% of the portfolio. Those, by and large, are in government securities as well. So we have a very large portion of the portfolio invested in government and agency securities, and of course that filters right along with your primary objective, which is the safety of principal. The portfolio is not designed to take on much, if any, credit risk. A few of the other highlights here, we have about 28% of the portfolio in certificates of deposit. That's up from about 15% a year ago. We found a number of banks offering some very attractive CD levels that we've been able to take advantage of. We also had about 5% of the portfolio invested in commercial paper at the end of September. That's actually relatively low compared to where we usually are. This time of year, the operating fund balances are on the decline. As Sharon mentioned a moment ago, this is sort of the low point in operating balances. More typical allocation to commercial paper would be around 25 to 30%. And as we start to receive some of those ad valorem tax inflows later this year, I do expect that we will see that commercial paper allocation move back up. The pie chart at the bottom left shows the allocation by issuer. The largest here is at Southside Bank. Those are primarily in certificates of deposit with Southside. Then we have Techstar, which is one of the local government investment pools. The U.S. Treasuries I mentioned a moment ago at 18%. And then we sort of spread the rest of the portfolio out in a handful of other items, U.S. government agencies such as Fannie Mae, Freddie Mac, the Federal Home Loan Bank. East West Bank is another one of the banks where we've been placing certificates of deposit. Texpool is another local government investment fund. Those funds provide liquidity. They're just like a money market mutual fund. They provide an attractive interest rate and a lot of liquidity for us. The middle table or the middle chart here with the bars is the maturity distribution. Weighted average maturity of the portfolio was 169 days. That's just a few days shorter than the same time a year ago. We've been maintaining a pretty short average maturity due to the rising rate environment. We want to be able to reinvest that portfolio in higher yielding investments, and so we want the portfolio to roll over fairly frequently. You'll also note here that we have virtually nothing in this portfolio invested beyond 2 years. Again, that's a strategy choice. We're deliberately staying short as interest rates rise. And of course, in your case, the operating fund making up such a large portion of the portfolio being very cyclical, your cash flows essentially dictate that we stay fairly short anyway. And of course, a very high credit quality with primarily government agency securities in the portfolio. The collateralized section here, those are the bank deposits which are secured by either Federal Home Loan Bank letters of credit or government agencies as pledged collateral. Moving on to the next page here, this is the benchmark comparison. This looks at the portfolio yield versus some of the market indicators, benchmarks that we use. The line, the sort of purplish violet line starts on the top left there is the JPS portfolio. We compare that primarily against the 1-year constant maturity treasury index and the 6-month constant maturity treasury index, which is the blue and green lines respectively. And you can see that the portfolio yield, was well above all those indices until earlier this year, and we started to fall behind a little bit. That's because the portfolio sort of lags behind as interest rates increase. We've seen the pace of rate hikes accelerate this year, and as a result, the portfolio is not quite keeping pace. It's also a function of the timing of your cash flows, with so much being invested from the property taxes in the December-January timeframe. And then those funds mature during the year and get spent, so we don't have the opportunity to reinvest some of those funds at higher yields. So as we move into the fourth quarter here and into the first quarter of next year, we should see a bump up in the portfolio yield as we have all that new money coming in and getting invested at what will be higher rates. I'll move on. I want to talk about the economic and interest rate environment for just a few minutes. There's been a lot going on this year, of course, and we'll highlight some of the big things here on this slide. These are all pretty important things for us to follow, very important for the investment environment. When I was here last December making this presentation, we talked about the possibility of tax cuts and tax reform. We did indeed see a round of tax cuts and tax reform package passed late last year. That's provided a significant boost to the economy here in 2018. Particularly in the second and third quarters. The other big news, of course, has been the trade war. All the talk of tariffs and trade negotiations. Really with the entire world, obviously the trade deficit and the battles going on with China have made most headlines. This is an ongoing issue, and this is going to be something that is very important as we move into 2019. It's also one of the reasons why we're seeing some stumbles in the stock market here more recently. There's a lot of concern surrounding this issue. It's also fairly important for us, the Federal Reserve. Janet Yellen's term as chairwoman expired earlier this year. That role was filled by Jay Powell, who took over. What's important for us here is that the Fed has been on a tightening path, essentially trying to, quote, normalize monetary policy. But they've been raising interest rates. I mentioned a total of 100 basis points since this time last year, essentially raising rates 25 basis points every quarter. We do expect additional hikes in December of this year. A hike in March is possible. When I put this together a week ago, it was still widely expected. Starting to be some doubts cast about that here more recently. And then, of course, the other big event was the elections and the Democrats taking control of the House of Representatives, and that could have some implications for policy, fiscal policy in particular, going forward. On this next slide, we'll look at gross domestic product, which is sort of the scorecard for economic growth. And you can see here over on the far right, 4.2% annualized growth rate in the quarter ended June of 2018. That did moderate a bit to 3.5% in September of 18, but as you can see, that's some of the best growth that we've seen in a number of years. In fact, those 2 quarters were the best growth rate we've seen in over 4 years. Obviously, the beneficiaries of the tax cuts and tax reform packages that we saw implemented late last year. On slide 6, we'll take a look at some inflation indicators. These have obviously been important this year as well. The blue bars here are the Consumer Price Index, a very familiar index. And you can see, particularly through the summer months in June and July, that the Consumer Price Index did move up. But more recently, we're starting to see those numbers moderate. The red line is what is known as the CPI core, and the core rate excludes some volatile components, particularly food and energy. And you can see a similar pattern here where it ramped up in the summer months and is beginning to filter back down. The core rate is really the key measure for most market participants. The gray line that's a little hard to see there is known as the Personal Consumption Expenditures Index. That's actually the Federal Reserve's preferred measure, and they actually have a 2% target for the core PCE. And you can see that that line is running right at that 2% target level. So essentially, inflation is running right at the Fed's target. But the gradual increase in some of these other lines, essentially helps to explain why the Fed has been raising interest rates. But it also shows us why the Fed has not been especially aggressive. 25 basis points every 3 months on a historical basis is a pretty modest pace of rate hikes. The inflation environment is not getting carried away to the point where they feel like they need to slam on the brakes, and really what they're doing is sort of taking their foot off the accelerator. Employment conditions have been quite good. You can see here that the unemployment rate has fallen to 3.7%. That's a 49-year low in the unemployment rate. And it used to be that anything around a 6% unemployment rate would have been considered full employment, and that has dropped to 5% and then 4%. But by any measures, the employment indicators are doing quite well. And in fact, average job growth so far in 2018, average monthly job growth, has actually been higher than it was in 2017. The strong job market is also beginning to add some wage pressures. We haven't seen much in terms of wage pressures for a long time, but as you can see here, particularly if you focus on the far right, the trend in that line is clearly moving higher. And this is another reason why we believe the Fed is starting to raise interest rates. The Fed doesn't object to seeing some higher wages, particularly if it's accompanied by higher productivity, but they don't want to allow the economy to overheat. They don't want to allow wages to ramp up dramatically higher. But we're sitting at about a 2.8% annual year-over-year change in employment costs at this point. And as you can see from this chart, that's actually still fairly low by historical standards. So we're seeing some upward trends in this, but again, it's not anything that's getting carried away. Housing market is one area where we have seen the impact of higher rates beginning to bite a little bit. 30-year fixed rate mortgages have now climbed over 5%, and you can see that the home sales data is beginning to slow. We're showing definite signs of slowing from earlier this year and particularly late last year. A couple things going on here. Of course, we've had several years of rapidly increasing prices. So home prices have reached record highs. And then, of course, you combine that with 5% and above mortgage rates, and suddenly affordability has taken a little bit of a hit. And we're seeing some slowing in home sales. Now, this is something that should be expected, of course, and frankly, it's probably something the Fed has been looking for, is home prices were beginning to ramp up a little too quickly. They were outpacing wage growth. So some moderation here should be expected, and is probably going to be welcomed by the Fed, perhaps a little bit less so by home builders and home sellers. I'll talk for just a moment about market movements. I mentioned the equity markets earlier. Sort of the figures in the middle of the table here indicate where equity markets have gone, and versus September 30 of last year to September 30 this year, you can see that the primary market indices have had pretty sharp increases, 18% on the Dow, 15% on the S&P 500, and 24% on the NASDAQ. But more recently, the month of October and even the month of November here have not been nearly as friendly. We've seen a pretty sharp pullback in October, November's been essentially flat so far, but quite a bit of volatility working its way in. And you can see on the top there, the year-to-date changes have gotten quite a bit smaller. The bottom table shows the interest rates and changes in interest rates. I provided both the comparison to September 30 last year versus September 30 this year, as well as the current levels. And these current levels were as of last Friday. We've actually seen yields fall a little bit lower from where they were last Friday. So some of what's going on in the stock market this week is driving what we call a flight to safety, and that's brought interest rates down a little bit from here. But by and large, you can see across the table here, the Fed funds rate up by 100 basis points. If you compare that 6-month Treasury bill a year ago at 119 to around 240 today, a 120 basis point increase. The same thing in that 2-year Treasury note where we went from a 1.5% level to around 285 today. It's been very close to 3% as recently as last week. So pretty dramatic increase in interest rates over the course of the last year. In terms of interest rates, these charts show the yield on the 2-year Treasury, the 3-year, the 5-year, and the 10-year. The dotted lines are the 200-day moving averages of each of those. And of course, you can see that the trends have definitely been higher. But we are seeing some indications that things are starting to flatten out. And particularly if you note the rate of increase in the 5-year and the 10-year, it has certainly slowed in recent months. And then finally, our crystal ball economic forecast, which is starting to get pretty cloudy here. Of course, over the course of last year, the economy has been quite strong. Growth has been very good. But we're starting to see some signs of strain emerging. I mentioned housing market. Obviously, a lot going on in the stock market. The tariffs are likely to raise costs for corporations. Some of those costs could indeed be passed on to consumers. That can result in two things. It can result in some inflationary pressures, but it can also result in an economic slowdown as consumers are forced to spend more money on necessities. So, this is going to be a really important thing to watch as we roll forward. President Trump has threatened to raise the 10% tariffs on Chinese goods up to 25% at the beginning of next year. There's some negotiations that are supposed to take place later this month. I think we're all hopeful that we'll see some progress there, but this is certainly a big issue that could have a dramatic impact on all financial markets as we move into next year, and of course the economy as well. So that's something to watch very, very closely. The other thing that we're keeping an eye on is the fiscal deficit position. The tax cuts have increased fiscal deficits. That, of course, has to be financed with additional borrowing. That means we're seeing additional Treasury issuance, so there's a lot more Treasury supply in the marketplace. Traditionally, that should put some upward pressure on interest rates, and so that's something that we're following quite closely as well. And with that, I'm done, and I'd be happy to try to answer any questions if you have any.
That was a great episode of CNBC.
There you go.
Very helpful, Greg. Thank you very much for that insight. Any questions for Greg on this? Okay, I guess you knocked it out of the park because they're all speechless.
All right, well, thank you very much.
Thank you, Greg, very much. All right, we're going to move along to item 5, 5A, I guess. 5, we already did 5. I guess you already did your financials, so how about 5B?
Good.
How about
You want
5B?
me to do them again? Because they're right here. It was a good month. I'll be
It was,
happy
yeah, I
to
know,
cover them
it's-
again. Let me
Let's-
have my moment. Yeah.
So we'll move to accept your report. We have a motion and a second. All in favor, please say aye. Opposed, motion passes. Thank
That
you.
vote also meant you don't have to do it twice.
That's right.
Is what that
I know
means.
he moved really
you can if you
quickly into
want,
that
though.
motion.
So we'll move
That's
to
okay.
item B.
Nothing personal. So I'm here to request approval for a 3-year contract with BKD. It averages about $200,000 a year for our external audit. There was an RFP conducted. The 3-year cost will be at $611,500.
You've heard Sharon's explanation. Any questions? Yes, ma'am.
Did we have a lot of folks respond to your RFP?
We, quite honestly, the usual suspects did not necessarily respond to the RFP. I think with some of the complexities that we have in our supplemental and government funding right now, a lot of the bigger firms are not necessarily going after the public hospitals or even healthcare. We did have 5 respondents. A couple of them I was not familiar with. We narrowed the 5 down to 3 for on-site presentations.
Okay,
Thank you.
all right.
Any other questions? I'll entertain a motion that,
Move approval.
we have a motion by Mr. Bose, second by Mr. Nguyen. All in favor, please say aye.
Aye.
Opposed? Motion passes. Thank you, Sharon. We'll move to item C, Zelia. Good
Good
morning.
morning.
Good morning.
I'm here to ask for approval, to consider approval of a service and support agreement between Translogic Corporation, doing business as Swiss Log Healthcare and Tarrant County Hospital District. This is a software and equipment service that is unique to correctional healthcare, and it actually provides real-time location of the inmates that are in the jails to allow for our nurses to appropriately know where to the inmates are and make sure that they get the right medication. So it's very much part of the flow with the jails. It's a $61,200 annual contract. We're asking for a 3-year term for $183,600 over the 3 years.
Right. And just to point out to the committee, the reason it's before us today is an exception to competitive bidding.
Correct.
Right,
Correct.
purchase of goods. Okay, any questions for Zelia? Motion by Dr. Schaefer, second by all in favor, please say aye.
Aye.
Opposed? Motion passes. Thank you.
Thank you very much.
Kenny, item 5D.
Morning.
Schrader, sorry.
Cheaper's fine, whatever you want to call it. I'm here to serve. That's your Tuesday, Thursday night.
I'm normally not up this early in the day, so it's. Hi,
Good morning,
Kenny.
everyone. My name is Kenny Carr. I'm the Senior Vice President for Network Operations. And I would offer it for consideration the approval of the service agreement between Abbott Laboratories and the Tarrant County Hospital District. And this would involve our Abbott Lumen Octopus, Opius, because it's for our IR as well as cath lab, utilized for the monitoring of stents, is also with cardiovascular diseases. This is an annual agreement of $21,500 for a 3-year term in total of $64,500.
Great. Thank you, Kenny. And again, this is big exception to our competitive bid requirements. So, any questions for Kenny? Entertain a motion? Motion by Dr. Schrader. Do I hear a second? Second by Mr. Nguyen. All in favor, please say aye. Opposed? Motion passes. Thank you, Kenny. All right, report of legal counsel.
Only report I have, Mr. Chairman, is that monthly I report there were 38 contracts that were negotiated that were under $500,000. Those were within Robert's contract authority, therefore don't come before you. If they are posted, that list is on your website or web portal.
All right, great. Any questions for council? And do we have anything in closed session? Any other items to come before the committee? Then we are adjourned.